All right. How's it going, everyone? Welcome to another episode of Forward Thinking Founders, where we talk to founders about their companies, their visions for the future, and how the two collide. Except for today. Today, we are having an investor segment, which I'm really excited to kind of have. We're talking with Zécca Lehn, who's a general partner at Responsibly Ventures. Welcome to the show. How's it going?
Matt, it's going great. Thank you for having me. I've been looking forward to chat with you on your show for some time. So excited to be here. Thank you.
Yeah, I'm excited to have you on. I feel like we're both kind of members of the Twitter sphere, tech Twitter, kind of that whole world.
I'm
So it's
still trying to
definitely,
get you to follow me, though. I've been working hard on this. You got to follow your biggest fans.
yeah, I kind of like try not to follow. Like to
No.
be honest, my strategy on Twitter, so I try to follow as many founders as I possibly can. And
Yeah.
because there's so many investors, I decided I don't know, like 3 months ago,
Oh
maybe like 6 months
gosh.
ago. Because the thing is, because it's not about liking or not, it's about priming the algorithm, right?
I
And like
like it.
my
Good
whole
work.
job is to find founders, so like that's why I pretty much follow founders these
You know
days.
what? I like your strategy. You just shared your strategy in the open. Don't do that. You
Oh
can
man, no,
edit that out.
I'm totally, I have nothing to hide. I think I have like at this point like 500 secrets on like how I've gotten to this point. So like I'm
Yeah.
happy to share, 5 or 10 of them.
You're following in the footsteps of Jason Calacanis being so open and candid and helpful that way.
Yeah, Jason, I mean, huge inspiration to me. I mean, he was involved with my last company, so I actually got to know him a little bit. And
Oh, amazing.
damn, he's he's a fantastic partner and just a fantastic investor. But anyways, all right. So no one, so you're ultimately, you're an investor, you're on the podcast. Let's kind of start with kind of who are you? If you can kind of give like a high level overview of what you do and maybe a little overview of Responsibly Ventures, just to give everyone an intro, then we can kind of dive in.
All right. Okay. Well, I think first I'll just start with the fund. The fund's it's a pre-seed fund, and we focus on these sub 10 million post-money types of opportunities. And it's a sustainability and social good focused fund. So I kind of gear the fund toward impact. That's kind of the lens we use. And it's a US focused fund. My background, I was an environmental economist way back in the day. I was a data scientist / data engineer, led some quant teams in quantitative finance, and then kind of leaned into venture the last few years. Have been a full-time angel investor before launching this fund for about 3 years. Got invested in about 40 startups across the U.S., all focused on sustainability and social good, from pre-seed to a one Series B deal, but the rest are pretty much all seed deals. And I could talk about that. I'm really proud of the performance, and just that I got to test that through the process of learning how to be an angel investor and applying it to the work I do today.
So I'm kind of curious there, in some ways, being an angel investor and being kind of a venture capitalist or managing someone else's money, in some ways it's very similar. In other ways, I mean, it's not at all. I'm curious, can you kind of like outline what have been the big similarities or differences from your angel investing career to now kind of having a fund? Are there anything that sticks out that kind of is, extremely different or extremely similar that kind of sticks out in your mind?
Really good question. Well, first and foremost, I have to say humbly that I have only ran a few very small businesses and have never tried to scale toward venture capital. So I'm incredibly humbled by the founders who are gearing themselves toward venture capital. I have to say I've kind of borrowed a lot of the insights from the thousands of calls I've had with them and interviews and et cetera, just getting to know what the constraints of venture capital look like, also with the VCs on the podcast interview, et cetera. Having said all of that, to your question, as an angel investor, I would say that there's a very strong similarity in that as an angel investor, you tend to be putting up your own money on a percentage basis that's somewhat similar. So let's say you're running a syndicate, you're putting in, say, a few 5% on a per deal basis, or you're investing directly, or you're investing through a syndicate, you're paying actual carry out of your own capital into those deals. I would say that your vested interests are aligned in the same way that you are as a general partner of a fund, because in the US, and I think in most places in the world, general partners invest a percentage of their own net worth into the actual fund. Now, some founders have ways to not invest up to say 5%. They can sort of monetize it through the cash flows of the fund to then reinvest as general partners. But at the end of the day, you're investing your own money into a fund, and LPs like to see that you're aligned in interest, and that's why the carried interest and the management fee component exists actually.
And kind of as someone in your position, you're out there looking for alpha, right? Looking for great founders to back, looking for industries that are interesting to you. I'm curious, in like today's environment and just 2021 as a whole, there's a lot going on. And like, what are like a lot? Like, what are some of the, I mean, not even markets, but what are some trends or things that you're paying attention to? It could be technologies, could be markets, but like what's catching your attention or what caught your attention in 2021?
Oh, okay. You're getting everybody excited right at the beginning of the show. I like your style, Matt. This is great. Okay. Well, I don't want to like do too much like promotional stuff, but I think where I can say that the things that fascinate me personally is this intersection of positive impact. And what that means is dynamic. I don't necessarily have a grasp on what that looks like in all cases. I use lots of frameworks as a guidepost for sustainability. So for my focus, I use the UN Sustainable Development Goals as a proxy for the types of deals that align with the motivation thesis of our fund. So for example, the SDGs are these 17 components that align everything from water impact to climate to social impact to health to land-based use and community and economic impact and industrial impact across these 12 components of sustainability. And in the fund, on a per deal basis, I look for opportunities that are largely overlooked by very vertical specific investors. So what I do is the thesis is we narrow the scope to the US, Fund One, and I look for impact focused deals that are geared toward what I call VC impact. And then in addition to that, I look for the deals that are less obvious to, let's say, climate tech investors or health tech investors or social commerce investors or consumer investors that may have multiple overlapping impact components that are gearing toward more sustainability. So it's kind of a purpose-driven fund in that way. And what that just basically does, it narrows down the set to a set of investors that have a motivation for impact. Many of these founders have incredible life stories, reasons for why they're doing what they're doing. You'll see just a tweet storm from yesterday on my Twitter account put out a question like, what is the positive impact positive impacts, plural, your startups are making? And you get everything across the board from people working in terms of age tech to, fair lending to, sexual wellness to environmental mitigation, et cetera, et cetera. I basically am able to connect with this broad set of investors who have a very strong social and economic and environmental mission attached to their business. And the question isn't, who are these founders? The question is, which ones of them can scale this business toward venture capital? And that's really where my work comes in. It's trying to work with those founders, get them geared up for venture capital and some of the constraints. So hopefully I didn't throw out too much there, but that's the focus.
I mean, it makes a lot of sense. And I mean, I think it's just like a smart strategy in general, kind of looking where other investors aren't. That's where the opportunity is for sure.
Thank you.
I'm curious, like venture capital is such a weird industry.
Let's talk about it. I love it.
You can't I feel like you can't just read a book and become a VC and like you kind of like you're in it and you get it and you understand the social dynamics of it, right?
Yeah,
it kind of takes some time, right, to actually understand what game you're playing. What was your journey like? And you can take this from whatever angle that you want.
I appreciate that.
How did you just learn the game of venture capital? And and you're probably still learning. We're all still learning, even the experts. So how do you treat
I love this question. I'm so eager to respond that I interrupted you. I apologize for that.
And no worries.
There's a great documentary that I just rewatched for like the 10th time it's on YouTube. You can rent it. It's called Something Ventured. Have you seen that film?
I have not, but I definitely need to. I've heard of it a few different times now, and it's kind of a sign I have to watch it.
Yeah, it's brilliant. And there's so many little kind of nuggets of wisdom and value in that film from seasoned venture capitalists. I mean, the industry spans back about 50 years with The first name that came to mind was Arthur Rock, and sort of the first founder of Sequoia, and the Traitorous Eight, and the origins of Silicon Valley, which was based in silicon production of computer chips in San Francisco Bay Area. And at the time when they first started their pursuit to discover this new emerging field of venture capital, there was there was really no playbook. They basically had to go out and collectively, as small funds, and find a deal, and then cooperatively go out and find, say, like a corporation, a bank, et cetera, to back that individual deal, sort of like a syndicate, you could say. And then they slowly started to discover, like, hey, we can actually raise funds for these things. And they share a lot of those stories. I don't know if I'm actually answering your question. Could you repeat the question?
Yeah, no, well, I guess like for you in specific, I mean, you started angel investing,
That's
then
it.
you kind of jumped into, you're now kind of in the fund world. I guess personally, like what have you learned
Yeah,
about
that's
this
it.
industry that you've kind of maybe taken away that you maybe didn't know 5, 10 years ago or from reading a book?
I appreciate that. Do you want the controversial version?
Oh, you know me. I mean, like I always want the controversial version.
Yeah,
Whatever
okay.
version you want to share, I'm game for it.
The one that gets me into trouble. I like that. Well, okay. So for one, I mean, the venture capital industry is at today's state highly unfair, and it is not necessarily ethical. It's not necessarily geared toward human, just cultural, racial, gender inclusion. And these elements are going to change through time, and they're going to change positively. But we're going through a growing pain right now because um, you know the world includes many different perspectives and many different backgrounds and lifestyles and many different markets that need to be served. And so that aspect is one that to me is meaningful. I think that the more inclusion we can have in the industry, the more statistics that show representation, that's amazing. I think that's a trend we're going to continue to see. Some of the less obvious aspects, I think, is just how important relationships are, and how to develop those relationships is kind of an art in itself. And showing value can be done in, I think, way more ways than I even realized when I first started. So how can I even? I'll give you an example. So I had a founder today call me, and I'm going to be very careful because I'm very guarded about all my founders, regardless if I invest in them or not. But they have a very advanced situation where uh, could cause a real problem in terms of negative signaling, called negative signaling, right? Um, and so the thing about this relationship is that they have a family office attached to their background. So I just candidly said, I'm raising funds right now under 506c for Responsibly Ventures. This seems like a very complicated legal situation. I can't give you legal advice. I can't steer you toward a particular outcome, but I want to show that there's some sort of value here. I'm giving you candid feedback about something that is probably going to materially affect your efforts going forward. So I just privately shared a couple thoughts, and I said, this is not advice. This is only private feedback. And so I developed good rapport there. And so this aspect of rapport and building relationships based on trust and recognition and empathy and these aspects, it's very overlooked in my opinion. And we talk about the ethics surrounding warm intros, democratizing the space, etc. I think those are all very important questions. But I think what's also very important is to have like a high level of empathy in the engagements, and obviously ethics. It's all a relationship business. We have to operate at a very high level of integrity. I think all of us have to in the industry. Does that
How do
make
you?
sense?
Oh, it
Hopefully.
makes total sense. I mean,
Awesome.
that's I mean, the whole game is like relationships and how to
I
build
agree.
them, how to get them, building trust, etc. Unfortunately, though, probably every founder in the world, even if they're born in Silicon Valley, at some point they don't know, they don't have many of the relationships, or
That's right.
for most, I mean, that aren't born in the Valley or New York, they have no relationships, so they kind of need to like learn on the go, like how to build them, how to foster them, how to leverage them, etc. Do
Yeah.
you have any maybe tips for,
Oh
let's
yeah,
call it just a first time founder, just the first time ever, no
sure.
family in venture, anything like that,
Mhm.
that they just want to like kind of step their toes in and build something great. What
Yeah,
advice would you give them if they, wanted to start building relationships, but don't necessarily know how to start?
that's a great question, Matt. I'm going to try to take a crack at this one. So in my view, one thing I see with early founders is they just don't realize that there's kind of like Twitter Spaces, Clubhouse, these places where we can engage. They don't know about platforms like yours where you can get deal flow to particular funds based on strategy and thesis and things like that. Um, some of these founders they fall into traps like pay to pitch. I don't know, pay us $5,000 and we'll give you one night in front of investors. There's no guarantee they'll invest. That type style of side of the industry, in my view, is very predatory. And so I would say for the most part, there are some resources to steer a first time founder away from less favorable opportunity sets. For example, there are just you know you can get access to credit cards. Obviously, Brex may be one to look at, but you may not want to put a bunch of money on a credit card and things like that. So I would say that focusing on execution for one, and focusing on getting your product to market, an MVP state where you have a testable hypothesis that you ran through with your customers, understanding what those customer needs are, and really gearing your product toward that gets you at least in the state where you can start having a serious conversation with angels. And then also, I'd say that getting advisors behind you early on, even one or two advisors that are not angel investors, that have a very strong industry focus, and you really want to align with them. You want to give them, maybe one, 0.5% of equity over 3 years or something like that on a vesting schedule that's very sensible, in not paying them cash. Those types of things can actually, they're kind of signs of traction, in my opinion. So you can get on shares these advisors that align on interest. They can start making intros to angels. They can start introducing you to potential customers. They can give great positive feedback. You get angels in that are the advisors that maybe even cutting a 10K check. Maybe you take on say 5, 10K checks. A couple of those are advisors. Maybe it's mostly just strategic because their networks are there, etc. And starting to maybe look at your co-founding team. Do you have people that are going to offer different aspects to the team? One thing I see a lot, as I see a lot of founders that take on too many founders, co-founders, they take on too many early employees and things like that. They have 20 people on the deck, and that to me just signals kind of too many mouths to feed. So how are you going to be capital efficient? Are you going to have to lay all these people off or cut them when you actually have to pay them, things like that. So there's kind of a delicate balance in that regard, in my opinion. I don't know if I'm going over the deep end, but you kind of get the idea.
I don't know. This is golden. I mean, I'm probably
I
gonna like
appreciate you.
take that snippet and like put it on Twitter, because that's like, I mean, it's almost
Appreciate
like
that.
there's a an industry where you raise your angel, pre-seed, seed, A, B, C, D, all the way through IPO. But what people don't really think about is within pre-seed, there is that in itself, which you just kind of outlined. It's like starting with, potential angels or advisors or co-founders or things like this. Like, these are things that no one tells founders, that are
Yeah.
outsiders, right? So I think it's great.
Thank you. I appreciate it. And I want to give a shout out to Stephen Price with Co-Founders Lab. They're doing a tremendous job in getting founders access to different like co-founders and other talent, things like that. So I wanted to give a shout out there.
Yeah, 100%. He's also, I've seen him on the Twitter sphere as well. And I think one of my last questions I want to ask is, about, I think I discovered Co-Founders Lab too, also on Twitter. I discovered you, and we met each other on Twitter or Clubhouse.
The best.
Can you kind
Yeah.
of like walk me through like why why should founders be on Twitter, like, that don't
Yeah.
know what's going on here? What would be your pitch for kind of an outsider founder that doesn't see the merits of Twitter yet?
Well, first of all, as a venture capitalist, we need to be constantly confirmed by others and told how great we are. So just that.
Of
And
course.
and then outside of that, I just think it's a great networking tool to be able to share content, share your wins as a founder, share industry news, things like that. It's just constantly focusing on adding value to a community. You may even find, like I'm speaking to directly the founders now, I think the founders may even find that by focusing on adding value and lifting others, kind of, it sounds so cliche, but paying things forward, focusing on the health of the community. We're in a community, so we're like the startup land community, venture community, whatever you want to call it. It's a place that needs people who are committed to its long-term success. And I think the basis of ethics is to not talk shit about the community, to not talk shit about other founders, to not talk shit about VCs, just to really focus on being positively and reinforcing good behaviors, because really it's relationship business. Behaviors matter. I mean, I'm not perfect. I try my best. I know everyone does. It's just to kind of reinforce that I think it's good to pay into the community that way. And Twitter's a great place to do that, in my opinion. It's a great way to show that you're there. One thing I do see, though, I'll say with first-time founders, like this is actually, I want to say this, and I haven't seen it as much recently, but when I first got started a few years ago, I saw it quite often, where founders almost felt like they needed to go to the big influencers, the big names that everybody knows has 500K followers, and put in kind of snarky, snide remarks, just show like, hey, I'm here, pay attention to me, etc. I don't think that that's the best value add strategy personally. I think the best value add strategy is to actually not necessarily disagree in the open with highly influential people, because they're not going to engage. It's mostly going to be others that are in that feed that are going to see that. I just think there are better ways than that. And maybe you can give me feedback on that too, Matt, because I'm still learning as I go, to be candid.
Yeah, well, I think that every founder is on an individual journey, and it's like the journey of like their startup, but also their self-development journey. And like obviously, like I'm on this journey myself. Like you follow me on Twitter a few years
You're
ago.
kicking ass. So
I'm a little.
yeah.
Well, yeah, but so I appreciate it. But even like you follow me like 2 years ago, and I'm kind of like that person you're talking about, right? Like I'm a little more aggressive, a little more opinionated, maybe less EQ. And the thing is, like, I think.
Well, yeah, but it's one thing to have a brand. It's another thing to be just a genuine good human. Like, I mean, we've shared stages before. I know your MO. Like, you may be a little dramatic to stimulate a little bit of hello, but like, at the end of the day, you're not there trying to harm anyone.
Well, so of course, like 100%. I mean, I believe my heart's in the right place. But the thing is, I guess my point is that I would say most founders also have their heart in the right place. They just might be a certain level of like rawness that they need to like kind of smooth out to kind of realize, oh, maybe like not bashing people, the influencers, is the best way to grow. But the only way to like learn that is to go through the pains of like the consequences of what happens when you do that. And it's just the journey, the founder's Twitter journey.
Matt, I gotta say this because I feel like you have an incredible like community and audience, and I don't mean like put anyone on the spot, but I have to say like this aspect of like bashing VCs. So it's weird, like a lot of mid-tier employees, senior level associates and analysts have less experience than a general partner who has full ownership, control and responsibility for let's say a fund. There's oftentimes by using the tag VC, it sometimes infers that a general partner behaves similarly than to an unexperienced analyst, I find. And it's almost like a straw man argument, and I get it. Like we're in a position of power, so we should be kept in check. I mean, always punch up, right? But at the same time, just candidly, I'm a solo GP. I'm a solo founder. I'm building a small business as a fund manager, and I actually sometimes am like, oh, wait a second. Well, that seems like a straw man, because even general partners and even associates or analysts that are just breaking into the industry, they need to be kept in check if they're behaving poorly. I totally agree with that. But at the same time, I also think that that they need a little bit of like cut them some slack too, I would say, because new first-time founders are going to fuck up. They're going to say silly things on Twitter once in a while, and it's okay. I mean, as long as we're being respectful and generous to each other, I think it's all okay.
Yes, I agree with that. It's the kind of the implicit rules and culture of tech Twitter, which anyone that isn't on tech Twitter that is listening to this conversation, you've heard me talk about it before in other podcasts. We're doing it again here. Please get on Twitter. This is like where it's happening, especially if you're not in one of the major tech hubs. And speaking of, Twitter will kind of like, where can people kind of learn more about you and what you're doing and your fund and your Twitter presence? I guess if someone wanted to connect with you, kind of after this podcast, because they like what you had to say, how could they do that?
Matt, you're incredible. I have to say, you are so great at interviewing. I learned so much from you, and I want to thank you for having me and being so open-minded. Really, follow me on Twitter. Follow you, Matt, on Twitter, and get engaged. So I do these weekly spaces on Twitter right now on VC Impact. Each week we impact kind of a different vertical that has a very high focus on sustainability and impact. Do those Fridays, 3:30 p.m. Pacific time to 5 p.m. every week. And would love, always, you're always welcome, Matt. And just want to say thank you again. So hope you have an awesome day.
Yeah, you too. And just the one last point to make sure people get the handle. What is your, like, if someone wanted to find you on Twitter, do they need to search your name? Do you have a specific handle? How can they find you?
Zécca_Lehn, and my DMs are open. If anyone wants precede, my DMs are open. I would just suggest engaging on Twitter. It's such a great value driver again.
All right. Well, he said the magic words, which is DMs are open. So if you're a founder listening to this, that's an invitation to ask him questions and learn from learn from him.
I want to say one thing though. By saying DMs are open, that does not mean it's socially appropriate to take a screen cap of a private conversation and post it on Twitter. That keeps us in check, of course, but definitely not something I encourage.
I completely agree with that. One of many learnings that founders will need to kind of go through to kind of get to the point where they're backable. So cool. Well, I appreciate you coming on to the podcast. Keep up the awesome work with the fund, and I'll see you on Twitter.
Thank you, Matt. Thank you again. I don't know if you want to stop recording or.